One of the hottest real estate investment trusts out there right now is Medical Properties Trust, stock ticker MPW, currently trading at $9.63. And over the past year, it has been on a huge downward trend. You can see it's down 37.7%, and year to date, down about 16.5%. Now, it's actually seen a little bit of a bounce up over the past month, up around 4.11%, and over the past days, up about 5.65%. Now, the reason so many are interested in this stock is look at that current starting dividend yield, sitting at 12.38%. So a couple of the questions we want to answer in today's video is the company trading at a good value at its current price? But we also want to know, what is the likelihood of a dividend cut, and is that starting dividend yield sustainable for this company? If we jump over to their website, one of the things you'll see is their total portfolio size is sitting at around $20 billion, and they own around 444 properties. Let's go ahead and jump back over to Seeking Alpha and start digging into the dividend sustainability for this company. So the first place you want to start is by clicking on this dividends tab. Let's look at this dividend history. One of the things you'll notice about this company, it does have a pretty decent dividend history, and it has also been increasing its dividend payouts as well over the past decade. Usually you don't see quite as much dividend growth from real estate investment trusts, but overall somewhat decent dividend growth for a real estate investment trust. Let's go ahead and click on our dividend growth tab. You can see it looks like the 3, 5, and 10-year dividend growth rates all sitting at around 3%. Again, somewhat decent for a real estate investment trust. But again, we want to know, how safe is this dividend? Because obviously that starting dividend yield sitting very nice, but is it sustainable? On our dividend safety tab, the first thing we want to glance at is you'll notice right here it says dividend payout ratio. This is typically the ratio that most people look at when judging a dividend safety, and it shows 156%, which would not be sustainable at all. But you have to understand, this is not the best way to judge a REIT's dividend safety. Payout ratio is not a good metric for a real estate investment trust. A much more important ratio to be looking at is the AFFO payout ratio. And you can see right here, it is still sitting pretty high at around 94.42%, but not nearly as high as the 156% as we just saw. You can see for the trailing 12 months, the AFFO payout ratio sitting at about 85.93%. So yes, both of those numbers are starting to climb a little bit higher than I would typically like to see it. So let's dig into it just a little bit more. To do that, let's go ahead and jump over to our financial statements. I'll click on financials, and the first thing I want to look at is on the balance sheet. If I scroll down a little bit, here we have cash and cash equivalents. You can see over here is 2013 and over here is 2022. And around 2018 to 2019, we saw a huge increase in their short-term cash and cash equivalents, which to me is nice because you know that dividend is safe if they have a large stockpile of cash. But look at 2019 to 2020 to 2021 to 2022. That cash and cash equivalents has been steadily declining by a pretty rapid rate. Now, that's not necessarily something that I like to see. It can be okay if the dividend is covered by the funds from operations. So if we jump back over to our summary, we can see that the forward-looking funds from operations for MPW is sitting at 1.55, while the current dividend payout is sitting at 1.16. So based off of those numbers, it would appear that the dividend is sustainable. But will the funds from operations continue to cover that dividend payout? Well, we can find that out as well. Let's go ahead and look at some more historical data. If we come over to the income statement and scroll all the way down here, we can see right here we have our funds from operation. Again, we have 2013 over here, and then we have 2022 over here. So it looks like there has been a pretty nice increase in the funds from operations over the past decade. In December of 2022, it was sitting at about $934 billion. So while the increase has been nice, is that enough to continue to sustain the dividend payouts? Well, to find that out, we need to jump over to the statement of cash flows. We'll click on cash flows, and we want to see how much this company has been paying out in dividends. So if I scroll down a little bit right here, you can see common dividends paid. So this is what we want to look at. If we come over here, we can see in 2022, they paid out almost $700 million in dividends. So again, based off of 2022's most recent numbers, it looks like the dividend is sustainable for now. But obviously, like we saw with those ratios just a moment ago, a lot of them are still starting to climb up higher, which is not something we want to see. Honestly, I wouldn't want to see it any higher than it's already sitting at. So I think the company is taking steps to try to lower these AFFO payout ratios. So what are they doing to make that happen? And if you've been keeping up with some of the Medical Properties Trust news, you know they have been having some problems with their tenants paying out the full amount of their rent. But we have some good news as of recently, which is probably why the stock price jumped up over the past few days. We can see the tenant Prospect Medical Holdings recapitalization should mean a safer dividend and more cash available for debt servicing by Medical Properties Trust. So overall for the company, that is good news. And we also have some news from a few months ago, and that's the sale of Medical Properties Trust Australian assets. If we come down here, we can see they have entered into agreement to sell all of its assets in Australia. The transaction, while done at a small discount to book value, will allow the company to fully repay its 2024 AUD term loan. So while selling off the company's assets is not typically something you like to see as a shareholder, I think overall that's probably a good move for the company if they want to be able to sustain that dividend payout. So I think my overall thoughts on the safety of this dividend is it is teetering on a dividend cut, but I think management is taking steps to try to sustain this dividend. Will that happen or not? I don't know. It is pretty close, but overall it does look like they are making steps to try to sustain that dividend. And like always, the second question we do need to answer in this video is the company even trading at a good price at $9.66? Obviously, it's tanked quite a bit over the past year. Well, the first thing that I definitely want to talk about in this video, even if I don't touch on it much, is the short interest. We can see the short interest for this company is sitting very high at 21.27%. To me, that is a huge red flag. As we've seen with situations like GameStop and AMC, companies that have short interest of over 10 or even 20% typically have a lot of downward pressure being put on them by large hedge funds. While that does mean there is a slight possibility of a short squeeze, that's not really a game I'd like to play. But let's go ahead and jump into my REIT valuation spreadsheet to see if we can find the fair value of Medical Properties Trust. We'll be looking at a few different valuation models like always. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description and join a community of dividend investors. But let's go ahead and come up here and plug in the stock ticker MPW and hit enter, and you can see all of this data will automatically load in. Now we're currently looking at a 500-day chart, so you can see again, obviously like I've already mentioned, a huge downward trend but a small spike up over the past month. Come over here, again you'll see that dividend yield sitting at 12%. Now the payout ratio, again this is something we've talked about, showing 230% for the trailing 12 months, but again we want to be looking at AFFO payout ratio for a real estate investment trust. So for REIT, this is really not a super relevant metric. If we look at these moving averages, we can actually see the 20 and 50-day moving averages all up by a decent amount, but that 200-day moving average still down quite a bit. We can see analysts currently have a target price of about $11.82, institutional ownership around 84%, and the beta is sitting at 0.97, so the volatility will follow that pretty closely of the market. Now the first valuation model that we are going to be looking at is the AFFO multiples valuation, and this is simply a way to see how the market is valuing companies that are similar in structure. So we obviously have some other healthcare REITs. We have Omega Healthcare Investors, we have HR, DOC, SBRA. We're looking at their stock price to get their price to AFFO multiple. Now the average price to AFFO multiple for these companies is sitting at about 12.68. If we look at it for MPW, it's sitting at 7.63. That's an indicator that the company may be undervalued. Obviously, there's a lot of risk priced into this stock, but based purely off the PFFO, it looks like the company should be trading at around $16.06 per share, meaning it looks like it's a little undervalued by the market. If we jump over to the historical price to FFO multiple valuation, this is actually a valuation model I think is a little bit underrated when valuing REITs because it values them based on how they have traded historically. So we look at that historical price per share, which I plugged in here. We plug in the historical FFO per share. So we can see we get our historical price to FFO over the past decade. If we look at this chart, we can see some of the trend lines, and it's been coming down for a little bit, but the average price to FFO over the last 10 years, you can see right here, sitting at 14.35, while for the trailing 12 months, it's sitting at 6.09. So again, based off how the company has traded historically, it would look like it's trading at a discount at its current prices. Now, the next valuation model, one of my favorites, is the dividend discount model. It values a company based on how much it pays out in dividends and how much that dividend is increasing over time. So I plugged in the quarterly dividend payouts for this company over the past 2 years, so we can see how much they pay out each year. And this allows us to see our year-over-year dividend growth rates. And like I've already mentioned, it typically hovers around 3%. You can see we have 3.85, 3.7, 3.57, and it does look like they have held off on increasing that dividend over their last cycle because for obvious reasons, they are trying to sustain the current dividend payout. So that's an average growth rate of about 2.8%. I think moving forward, if they achieve a dividend growth rate of 1%, with a discount rate of 8.5, we come to a dividend discount model price per share of $15.62. Again, a decent bit higher than that current trading price. Now, the next valuation model that I sometimes use is the net asset value, but there's so many different variables for this company and for this valuation model, I don't think it would provide a fair value, so I didn't use it in this scenario. So when we jump over to our output tab, we can see the two valuations that we use. We have the AFFO multiples and the dividend discount model. When we average those two out together, we come to an intrinsic value of $15.84. with the company currently trading at $9.66. If we were to apply a 20% margin of safety, it looks like our acceptable buy price is sitting at around $12.67, with a 30% margin of safety, the acceptable buy price sitting at $11.09. So based purely off the fundamentals, yes, it does look like the company is a little bit undervalued, but I think there's a lot more to the company than just the fundamentals at this point. To me, the two biggest concerns that I have is the large and growing short interest that I touched on earlier. To me, that's a pretty dangerous red flag. I don't typically like to mess with companies that have that high of short interest, but also the concerns over their tenants. To me, that is another big concern. Anytime you have a problem with your tenants as a real estate investment trust, that's potentially a huge problem for the company. If the tenants have trouble paying Medical Properties Trust their rent, the Medical Properties Trust is going to have trouble paying its investors its dividends. So I am happy to see that it looks like management is taking steps to try to sustain that dividend, but I don't know yet what the end result will be. I think a dividend cut is still possible because a lot of those payout ratios are sitting pretty high, but again, they are taking steps to try to sustain that. So there you go. There's a quick analysis on Medical Properties Trust. Go ahead and let me know what you think of this company down in the comments down below. If you'd like to be able to download this spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.